This is the first video of the Chapter 8 series on inventory. There's some background information that you should review from the chapter that won't be captured by these videos. This first series of videos is going to simply go through all the different cost flow assumptions. And so our cost flow assumptions are the different methods in which we can calculate our cost of goods sold. One of the things that you should notice is that under each of these cost flow assumptions, you're going to end up with a different cost of goods sold and a different ending inventory, right? So it's important to keep in mind that the decision you make as to which method you choose for costing out your inventory is going to have an impact on your balance sheet and on your income statement. At the end of the day, all the cost flow assumption is an allocation of cost of goods available for sale, right? Which effectively is opening inventory plus purchases. So let's say we have opening inventory of $5,000 and we purchase $20,000 worth of inventory during the period. We have $25,000 that we can now allocate between two items, our ending inventory and our cost of goods sold. The way we decide how much we allocate to cost of goods sold is based on the cost flow assumption that we choose. So there's four primary cost flow assumptions that we're going to go through. This first video deals with specific identification. Right, so specific ID is the least used method out of the four, and the reason that is because each inventory item has to have a distinct identity, meaning there has to be something that makes it unique so that we can track it individually. So the actual cost of the inventory unit is used to calculate your cost of goods sold. Examples of companies that might use this would be an automobile dealership, a company that sells automobiles. If you think about it, you could have 10 Ford Mustangs on your lot with the same color and the same specs, but every single car has a VIN, a vehicle identification number, that makes it unique. So dealerships can track their costs based on the VIN of the vehicle. So they can cost out the specific cost of that vehicle when they sell it. Jewelers is another good example. They typically have low volume, right? So they don't have a whole lot of rings in stock, but each inventory item is usually expensive, and you can usually identify it separately from the other rings, okay? And we're going to go through an example here. We're going to take one example. We're going to go through all the cost flow assumptions. So specific ID is normal for high cost, low volume inventory. So why don't we take a look at that example right now. Cost flow assumptions. So KC Jewelers has no opening inventory and had the following activity for the month of February. Alright, so there was no opening inventory for KC Jewelers. On February 5th, they purchased a ruby ring for $4,000. On February 14th, they purchased a diamond ring for $8,000. And on February 16th, they sell the diamond ring for $14,000. And then the last transaction is on February 23rd, they purchased an emerald ring for $3,000. Okay, so our first requirement is asking us to use specific identification to calculate the cost of goods sold for the month of February and the ending inventory. If you remember, under specific ID, we cost out the exact ring that was sold. So the way specific ID works is we figure out which inventory unit was sold, we figure out how much it cost us, and that becomes the cost of goods sold. We pull that out of inventory, right? So each inventory is unique. In this case, we had a ruby ring, a diamond ring, and an emerald ring. It's pretty easy for us to figure out the cost of the ring that was sold because we know we sold the diamond ring. Alright? So when we do our cost of goods sold calculation for the month, basically cost of goods sold is quite simply the value of the diamond ring. And if you look back up top, we purchased the diamond ring for $8,000. So my cost of goods sold would be $8,000. To calculate ending inventory, we just figure out what rings are left in ending inventory and assign their costs. So we purchased a ruby ring for $4,000, that's still in inventory, and we've still got this emerald ring for $3,000 in inventory. So when we calculate our ending inventory, we're just going to list those unique items that are in inventory and subtotal them. Okay? So in this case, our cost of goods sold is $8,000 and our ending inventory is $7,000. Right? In a nutshell, that's specific ID. We take the exact item that was sold and we cost it out. Right? We could have done this exact same example, but instead of selling the diamond ring, we could have sold the emerald ring. In that case, the cost of goods sold would have switched to $3,000. And other than that, there's really nothing else to specific ID. So you're typically going to have lower volume, higher cost inventory items. They all need to be unique in that we can track the individual cost for each separately. And when we sell an individual inventory item, we're going to cost it out at the exact cost that we paid for it. So the next video we'll move on and we'll use this same example and we'll talk about first in, first out.